In this video, we will find out if the bond market carried a warning sign that could have helped you to protect your stock portfolio from the 2000 dot-com crash. Could we have predicted the bubble burst, as bonds usually change direction before stocks? Hey everyone, welcome again to fojoresearch. Investors often seek safe havens during stock market crashes, but what is the best strategy for doing so? Are you aware that commodity prices affect bond prices, which in turn influence stocks? Meaning that if you want to be a successful investor, you will need to consider both the bond and commodity markets. We will help you on this journey of discovery. Everybody ready? Good. Let's rock and roll. The link between commodities and bonds. In a nutshell, rising commodity prices are viewed as a leading indicator of inflation and can dictate a central bank's monetary policy and the direction of interest rates. Higher inflation may translate into higher interest rates, which negatively affects bond prices. As a result, commodity and bond prices usually trend in opposite directions. For example, soaring commodity prices normally cause bond prices to fall, whereas falling commodity prices result in higher bond prices. Furthermore, bond prices move inversely to bond yields. However, in the havoc of a stock market, when stock prices are falling, the market is overwhelmed by a panic, and nobody seems to know what to do. The correlation between commodities and bonds can run wild. In short, besides discovering if the bond market led stocks before the dot-com crash, we will also explore the relationship between commodities and bonds before and during the crash. So, if you're curious to know, keep watching. The 1990s, disinflationary decade. Overall, commodity prices fell, and bond prices rose during the last 2 decades of the 20th century. The commodities reached lower levels in the 1990s as the disinflationary environment prevailed. Moreover, falling commodity prices and interest rates are an excellent way to explain a disinflationary period. And here's the thing. Bonds usually rise when inflation is in check, and interest rates are declining. This generally appeals to investors because they are attracted to the bond's promise of safety and income. Now, let's look at the 1990s trend through this chart. As you can see, an interruption of the downward trend of the commodity market took place. For example, in 1993, when prices began rising again. Red line. Well, notice how the rise in the commodity market led to a downturn in bond prices with some time lag. Black line. It is an excellent example of how intermarket relationships can sometimes seem out of line for some time, but still carry a warning. But as we move further and look at the trends during 1997 and 1998, notice how both markets did exactly what they would be expected to do during a threat of falling prices, which is deflation. Commodity prices fell sharply while bond prices surged. This was the time of the Asian currency crisis. In 1999, when the Asian economies were recovering, bond prices fell sharply as the rising price of oil and industrial commodities pushed interest rates higher as inflation fears reemerged. But what happened before the dot-com market collapse that lasted between September 2000 and February 2003? Could you have predicted the crash, as bonds usually change direction before stocks? In mid-1999, and considerably before the stock market crash, commodities started appreciating in value significantly. Now, let's look at the trend through this chart. As you can see, This brought about a rise in short-term interest rates as the Federal Reserve adopted a more restrictive monetary policy, red line. The Fed started increasing the Fed funds rate by June 1999 and followed the same path until the end of 2000. As a result, the 30-year Treasury bond yield kept rising, blue line, which could have been regarded as a key cautionary signal that might have led to the beginning of a stock market crisis. However, the increase in the Fed funds rate had a momentary and limited impact on long-term interest rates as the 30-year Treasury bond representative peaked in January 2000, 8 months before stocks peaked that September. So, the 30-year Treasury bond yield unexpectedly started falling in January 2000, and the bond market rising. This went against the traditional intermarket relationship, which stated that at major tops, we would expect bonds to decline before stocks. Nevertheless, one can say that as the Fed funds rate was rising since June 1999, this could be viewed as a key cautionary signal that led to the stock market crisis in September 2000. And what happened during the stock market crash? The 2000 dot-com market crash caused a massive flow out of stocks and into Treasury bonds, pushing bond prices higher, upper black line. With this downturn of stock prices and the hovering deflation over the heads, the Fed eased its monetary policy, trying this way to control the aftermath of the crisis. The loose monetary policy, initiated by the Fed in the beginning of 2001, pushed down interest rates, which also led to increased bond prices, black up arrow. Furthermore, the dollar, which became a low-yielding currency, fell sharply at the start of 2002, green down arrow. This caused commodity prices, red up arrow, to turn up before stocks. This was unusual, since stocks have a history of turning up first at bottoms. So, starting in 2002 and until the end of the bear market, bond and commodity prices were both on the rise. In the chaos of this stock market crash, the inverse correlation between commodities and bonds was temporarily lost. But, along with the loose monetary policy, what caused this new pattern? Let's unravel the mystery behind it. In the third quarter of 2002, and as a result of a drought in the US Midwest, some commodities prices soared, boosting the commodity index. However, copper prices, which is viewed as a better economic indicator than grain markets, fell over the same period. And as copper is negatively correlated to bond prices, bondholders decided to hold their positions and not sell their bonds, despite the rising commodity index. So, the interpretation made by bondholders of the situation contributed to explain why bond prices also rose during that period. Major takeaways. The threat of a deflationary environment dampened the normal bond-stock relationship. That said, unlike of what happened in the 1970s and 1980s, falling bond yields or rising bond prices preceded the 2000 stock market crash. So, falling bond yields became bad for stocks. Commodities and bonds continued to behave as two opposite sides of the fence, with this significant exception, 2002 and 2003, meaning that in the chaos of the stock market crash, the inverse correlation between commodities and bonds can run amok. Changes to the normal bond-commodity relationship are usually caused by actions in stocks or the dollar. The dollar and commodities trend in opposite directions. So folks, this was all for today. If you like this type of content, make sure to hit that like button, subscribe to fojoresearch, and turn on our notifications to stay updated. Comment down below and share your thoughts with us. And don't forget to visit our website as well as our Twitter account, as we will occasionally post some trading signals there. We're leaving the links in the description below. Oh, by the way, interested in knowing what occurred during the 1970s and 1980s, or curious to know what happened before and during the Great Recession of 2007 and 08? Check out these videos on the screen. Thank you for watching, and we will see you in the next one.